Wonderful. I hope everybody can hear me. Welcome everyone to our Q4 2025 quarterly update. And we're going to be talking about the Rise, which is in Conyers, Georgia. So we acquired this gorgeous property in August of 2025, again, Conyers, Georgia. And just for a quick recap, the Rise was built in 2022 and it was a great acquisition. We acquired the property at below replacement cost and we're able to get it off market. So that was like a big thing that really helped us because the seller had some issues with some distress on his side, on the debt side. So we're able to acquire the property at a good price. So it was good for us. We bought this brand new property and that was already producing income at a very good basis. So since takeover, it's been doing well. This is one of the properties that you enjoy getting on the asset management calls because it's just kind of a lot of highs on how the property is doing, how the asset is performing. And one of the reasons why we really love the market that we're buying in, again, it's because of just how well it's doing. If you look at the demographic data, right, Conyers is growing. It's growing at a really great rate. So it's one of those submarkets that really, at a rapid rate, we're seeing growth and we are benefiting from that. So again, I want to say to all of those, if you're listening to this as a replay or if you're here, I just want to say thank you for being part of the investment group. And this call really is to just, kind of walk you through what last quarter looked like and how we are thinking about the year to come. If you have any questions at all, right, when we get to Q&A, feel free to unmute yourself or even toss it in the chat and I will definitely be able to get to it. But as people are coming in, I just want to say welcome. So this is the biggest thing that we had to take care of early on when we acquired the assets is that we did inherit a few tenants that were delinquent. So these tenants had high balances that we didn't know, but we took over. And one of them claimed that they were a sovereign citizen, which means that they were not required to pay rent. But thankfully, we took them to court. The judge, the lawyers all agreed, and we were able to kick him out and write off the balance. And we had another woman who also had a huge balance, and she refused to pay. But again, right, we were able to get her out as well. So now those are the two that we inherited from the old sellers that had really large balances. And now we're actually able to get really qualified tenants. We did reach out to the seller and ask to reimburse us for some of those incomes that were lost from the delinquency. So that's something that we did. And I just want you guys to know that. So we came in and within a few months of ownership, we really started executing on our capital expenditure plan. So all our plans for renovation, what we wanted to start doing, we started doing them right away. One of the things we did very quickly is our smart locks and smart thermostat. So the property is a new property, 2022. So we wanted to think more of a technology package of what we would add to the property. So the first thing we did was smart locks, smart thermostats, and that was installed within the very first few months that we owned it. So now all the tenants have smart locks, they have smart thermostats in their units, but also in the few units that are not rented out, right? We are able to control the temperature because we have smart thermostats in them as well. So we're able to save on power. And we also did a property-wide dry vent cleaning. So to eliminate any risk of fire on the property that might come from that. So those are some of the things that we did earlier on in terms from a capital expenditure standpoint. We also improved the curb appeal significantly. So, and the next time we do this, I'll get pictures of like what it looks like now because it's really pretty. But another thing we did was we instituted valet trash. So that means 6 days out of the week, right? Tenants can just leave their trash outside and we take it and we pick it up, right? And so with that program, we instituted a new valet charge. So that is also going to help us with income generation. The old owner, they didn't do anything about that. And so this is new and this is additional income source that we're going to see in the months ahead in the property. We're also planning there's a space that we carved out for a package locker, but we deferred that to install it kind of January, February. So that's in the process right now. We just had a lot that we were doing in that December period. So the last quarter, we did acquire the property in August. So really a little bit of third quarter and then into fourth quarter. So we had a lot that was going on. So we said we're just going to defer the package lockers to this year, beginning of this year. So that is coordinating, that is underway. And so those are kind of some of the big CapEx plans that we did and that are about to be completed. Again, for the new people that are just coming in, if you have any questions at all, please feel free to put it in the chat, or if there's something in the beginning that you didn't understand, you want me to go over, please feel free to include that, or when we're at Q&A section, just unmute yourself. So from an occupancy standpoint, right, as you can see, middle of October going into November, occupancy was at 95 to 97% occupancy. The property, again, is doing well. But towards the end of the year, as we had to evict those non-paying tenants, especially those two large balances, right, occupancy went down, but it should go back up to mid-90s or higher in the next weeks ahead. And we use Rent Vision. So that really looks at occupancy on a weekly basis and kind of helps us project or like target what we need to do to get occupancy up. So from an occupancy side, except those delinquencies towards the end of the year, the property is performing really well. We're getting a good number of traffic of interested tenants, and we're making sure this time around that they're really qualified. So the property is doing well. It's growing. We're getting qualified tenants, so we expect occupancy to go up pretty quickly. Again, we really love this market, and we're seeing kind of right now is a true kind of exhibition of the strength of the market. So I told you delinquency, bad debt, a bunch of stuff we did was to clean that up in 2025. Those people that we evicted, kind of their balance was about 44,000. And that's a lot, but now that is off our books. So it almost feels like we're starting afresh, right? So again, we're bringing in a lot of qualified tenants. And then occupancy kind of is going to remain stable. Our plan is during that cleanup, right, when we're cleaning people out, it stayed stable at 96%. It dropped after the cleanup to like 93, 94%. And so we want to maintain that high occupancy. That's our goal. It really gives us an opportunity to start implementing a lot of the things that are going to drive income up. And all those things we did. So the smart locker, the smart thermostat, the package lockers, we're actually going to start implementing like a technology fee as we kind of install everything. So that's something that the tenants are going to see kind of moving forward. Again, the last thing that we really need to do is just the package locker. And then as a sum, we'll be able to charge them a fee and capture that value as well. So even if it's a new property and it's performing well, we're still always thinking, how can we get some additional value into the
preliminary report for.
Let me just mute him. There we go. Perfect. So thinking through, the biggest thing, and a lot of, we send out monthly updates, which I forgot to mention, but if you are not receiving them, and I believe everyone should, please let me know. A lot of the things that we're talking about here is really a recap of what our team curates in the monthly update to let you know. So the biggest thing, again, is capital expenditure, kind of where expenses are, where what income is coming into the property. So, and then also distributions. So I wanted to kind of talk about distributions just to bring that back up, right? As a recap, your first distributions were issued out. And so the first distribution actually included 2 distributions. So remember we closed August. So part of Q3, third quarter when we closed, you got that distribution. And then you also got a full quarter of Q4 of 2025. So you also got that distribution. Then there were certain people who funded very, very early. There was a bonus window where we said, if you fund by this time, you would get an additional distribution. So those people got a third distribution. So if you didn't get it, most likely you didn't fund as early as those people did. So I just wanted to make sure, but if you did and you didn't get that distribution, please let me know and I'll touch base with our finance team and make sure that that's included. But so distributions are on track based on our projections. If you remember kind of our goal year 1, we projected that we would distribute around 3.4%. And that's exactly what we get. But you are entitled to 6% return on your money every year. So the rest of that wasn't paid out gets deferred into the next year. So the goal is that, as we kind of go in and as we've continued to increase the performance of the property, increase income, decrease expenses, right? You'll be able to get the full 6% return on your money. But what we didn't distribute will get distributed next year. So going into Q1 of 2026, our goal is that like that distribution is going to increase to hit our 6% as soon as possible. That's like one of the big things that we're always thinking about. What do we need to do to improve the performance of the property so that our investors will get paid? So right now, based on our underwriting, we are on track. We're hitting our projections. And honestly, the way the rise is going, this truly will be one of those properties. I'm not going to be surprised if we surpass our projections, if we go past 6%, just because of how well it's performing. But it's too early for me to kind of say anything because we've only had it for about 5-6 months. But just kind of where we see it going and the trajectory and the cleanup that we've done, and to see kind of how the property is performing has been really good. So we will really see all of this. We'll see the fruit of it in the next few months. Again, so this is just kind of a recap and the breakdown. I want to make sure that it's clear. I want investors to really understand their distributions, what they're getting, and I'll make sure we put this in the email. So when we send out the recap of the video, I'm also just going to include that. And again, right, if you want more of a breakdown of exactly the distributions, please just let me know. And again, this is just another slide on really the breakdown of it. So if you want to take a picture, but again, these slides, I'll send it. You'll have access to it, so you'll see it. So kind of wrapping up, I wanted this to really be kind of short and sweet and to give us a time to ask questions, right? The biggest kind of talking points looking at Q4 is truly that, the rise is a stable asset. It's in a market that's growing really well. And we have a great understanding for the market. So our focus this year is kind of two-part, right? It's going to be completing all the upgrades that we said we're going to do. So before the end of the quarter, we should have the package lockers all figured out and include that. And then we're going to be focusing on really just managing the fundamentals. That's the biggest thing. It's a great property. There's not much to be done there. So it's really just management is what we're going in there. And the beautiful thing about it is that we love the demographic trend in the Atlanta market and the surrounding MSA. So our goal at Phoenix is that we're going to be acquiring more deals in the market, and the more properties that we acquire, right, the more benefit it gets for all our other properties. So the rise is one of them. So what I mean by that is we are even thinking about shared staffing. So we're closing on another property that's about 5 minutes away from the rise, and that's called Park at Arlington. So once we take over that property in the next 2 to 3 weeks, right, it's going to help us share some of our resources between the rise, the park. And so we're able to save on the expense side. That's something that we have to be thinking about in how we, as we acquire, right, as we build out an asset portfolio in a certain area. That's one of the benefits of doing that is we're able to manage it better, but we're also able to share revenue. So a lot of what we think about in terms of how the property works is that we always think about revenue growth, and that's always thinking about increasing rent. But really a powerful way of really growing the value of the property is actually to decrease the expenses. So as you know, right, the value of the property is net operating income is based on the income and the expenses. So our goal, we're always thinking, especially, as we manage the asset, as we speak to our property management team, is how can we increase the income, the revenue, and how can we decrease expenses? So as we're buying more assets in the market, right, we have really creative ways of how we're going to be decreasing expenses. We're going to hire in-house team members to do a lot of the things that maybe we would have contracted out. And we can do that now because, we have multiple properties. So I'll give you kind of a good example as we wrap up, right? In one of our properties, we have one of our maintenance specialists who's a really good painter. So he works overtime to paint the units in the other properties, right? And it's saving us a lot of money because when we contract that out, it's about $700 to like $1,000 per unit, but where he's getting $200 plus bonus on top of that. So it's just It's a no-brainer when we start thinking about bringing it in-house and we start split sharing. So that's what we're thinking. That's kind of how we're planning to do this. We are happy with the management team, but the on-site management team and our property management team, they're just doing an excellent job. Customer service is really good. We are getting like 5 out of 5 reviews on Google. So the goal, right, as we're thinking, how can we do this? How can we manage it better? We want to make sure that tenants are not leaving. We want to make sure that our tenants are really happy. We're continuing to implement all the things that we need to do to increase income. And we're not significantly increasing income. We're going to be at market, and then make sure that any additional things kind of is where the market is in the Conyers Covington area. So, and the goal is that as we're seeing that increase, right, we're thinking about distributing to our investors. And as we think about growing the asset, we're always thinking about you guys. But that's some of the, in the last quarter, that's some of the things that we've thought about, that, and we plan to implement. So as I wrap up, I want to talk about just real quickly Park at Arlington. It's that new property that I told you that will be closing within the next 2 to 3 weeks. If you haven't heard about it and you're potentially interested, reach out to me, reach out to one of our team members, and I'd love to kind of tell you about it. Again, tell you what our investment thesis is, what our strategy is, and we'll be able to get you into the deal. So I want to say thank you for your time. I'll stop sharing. If you have any questions at all, like if there's, anything that maybe you thought about, like while we've owned the asset, but you haven't had access to ask me, I'd love for you to bring it up right now. So I'm going to stop sharing so I can see everyone. Hi, everyone. So yeah, if you have any questions, toss it in the chat. Is there a question in the chat? Okay. Oh, wait, there is one. How do we get, thank you for bringing this up. Oh, I forgot to mention this in the last update. You will get, the question was, how do we get tax documents to file for our 2025 taxes? Great question. Oh, I missed that one. Within the next, and you are going to get an email from me within the next week or two about it, but we are hoping by early March, you should have your K1s. So everyone, we are pushing our CPA company to get it out to us by end of February, just because we're doing it for multiple properties. So early March, you should have your tax documents. It will be in the portal. I'm pretty sure that we have made sure that everyone knows how to get into the portal, update their financial information. You will see the tax documents in the portal. And if you are in additional other deals, you'll be able to see multiple K1s for every property. Thank you. That was a really good question. Any other questions? And I'm hopeful that if you got this email, you are on the email chain, so you're getting all the monthly updates. Those emails come from me. So if you if anything quickly, you could just hit reply and I'll be able to get back to you. Or again, Grace is on the call and I know most of you have spoken with her. So she's accessible. I'm accessible in any way you need to reach out to us. But I'm going to give you back some of your time this evening. If there are if there are not any other questions, if there aren't any other questions.
This is very insightful. Thank you so much.
You're
And
welcome.
question it was the same about the K1. So, but
Okay.
yeah, it sounds great. Thank you so much.
Wonderful. Oh, I'm so happy to hear that. Yes, if there aren't any other questions, I will let you guys go. It's been a long Monday for me.
All right. Thank
Okay, see you,
you.
everyone. Have a wonderful evening. Bye.